Welcome back to Talk Tickers. We are stripping the fluff from the press releases, ignoring the corporate cheerleading, and getting straight to the numbers that actually move markets. Today is Wednesday, February 4th, 2026. We are looking at Amdocs, and frankly, we're looking at a bit of a crime scene here.
It wasn't pretty. The ticker is DOX. They reported their Q1 FY2026 earnings yesterday after the bell. And, the market treated them like they just announced they were setting money on fire.
Yeah, no kidding. The stock was just hammered in after-hours trading, dropped nearly 9%. It's hovering around $81, which is dangerously close to a 52-week low.
Very close. And here's the thing that makes this a perfect Talk Tickers case study. On paper, they won.
Exactly. They beat revenue estimates. They beat earnings estimates. They even reiterated their guidance for the rest of the year. I mean, usually that's a recipe for a green arrow.
But instead, investors just hit the eject button.
It's that classic good news is bad news scenario, but with a twist.
It really is. The market is sniffing out a disconnect between, the spreadsheets and the actual strategy. We need to unpack three specific things today. There's a surprise CEO resignation that has people nervous, a very confusing situation with their biggest client, T-Mobile, and an AI strategy that, sounds cool, but isn't making any money yet.
Okay, let's start with a report card. Before we get into all the drama, what did they actually post? Because if you just read the headline, you'd think everything was fine.
Yeah, the headline numbers were solid. Revenue came in at $1.156 billion.
Which beat the consensus.
Right, it beat consensus. And that puts them at about 4.1% growth year over year. If you strip out currency fluctuations, it's closer to 3.5%.
4% growth. I mean, it's not NVIDIA, but for a utility-style company, that's fine.
It's steady. It's exactly what they promised. And the bottom line was actually even better. Non-GAAP earnings per share came in at $1.81.
$1.81, beating the street's expectation to $1.75?
Yeah, a 6-cent beat.
Hang on, let's pause on non-GAAP for a second. We always see this discrepancy. Why does it matter so much here?
It matters because of what they're stripping out. I mean, non-GAAP excludes things like stock-based compensation and acquisition-related costs. When you look at their non-GAAP operating margin, it's 21.6%.
Which is very healthy.
It's a very healthy, efficient number. It tells us that the core business, the machine that processes bills and manages data, is running efficiently. They aren't bloating up. But, and this is a big but, the market isn't looking at what they did. It's looking at what they said about the future.
And what they said was, they reiterated guidance. They didn't cut it. They said, we are still on track for 1.5 to 5.5% revenue growth.
Yeah.
Usually reiterating guidance is neutral. Why did the market take it as such a negative?
It's all about the context surrounding the leadership. You don't just look at the numbers. You look at who is signing the checks. And right now, that is changing.
Right. The CEO, Shuki Sheffer, he's been running the show for 7 years.
And now he's retiring. The announcement dropped right alongside the earnings. He's handing the keys to Shimi Hortig, a longtime Amdocs insider, effective March 31st.
Okay, I have to play devil's advocate here. If CEOs retire, it happens all the time. He did 7 years. Why is the market freaking out? Is it just that they hate change?
It's the timing. I mean, think about where the telecom industry is right now. We are in the middle of the biggest pivot in 20 years, the shift to AI-driven operations.
Right.
Everyone is scrambling to figure out how to automate their networks. This is, a wartime moment for tech strategy.
And swapping generals in the middle of a war makes people nervous.
Precisely. Even though they claim this is a planned transition, and even though Shimi has been there forever, institutional investors, they get paranoid. They start asking, does Shuki know something we don't? Is the next quarter going to be a disaster? Is the new guy going to come in and kitchen sink the guidance?
Oh, a kitchen sink, meaning the new CEO comes in, lowers all the targets, blames the old guy, and basically sets the bar so low he can just step over it later.
That is the standard playbook. So when investors see a leadership change combined with reiterated guidance that looks a little flat, they assume the other shoe is about to drop. They are pricing in the risk that Shimi is going to have to pivot hard in Q2 or Q3.
It feels like there's more to it than just the CEO, though. There's a specific detail about T-Mobile that seemed to really spook people.
Yeah.
And this is what we're calling the T-Mobile paradox.
This is the most critical piece of the puzzle on the revenue side. T-Mobile is a massive client. Amdocs just announced a huge win a 5-year renewal agreement. It covers managed services, software development, AI, everything.
Okay, so they locked in their biggest customer for 5 years. That sounds like a reason to buy the stock, not sell it.
You have to read the fine print. Despite signing this massive renewal, Amdocs explicitly stated that they expect revenue from T-Mobile to decline in fiscal 2026.
That makes zero sense. We signed a new deal, and now you're going to pay us less. How does that math work?
It's not about the rate. It's about the project lifecycle. You have to remember what happened with T-Mobile recently. They acquired U.S. Cellular.
Right, that was a huge merger.
A massive merger. And Amdocs was brought in to do the heavy lifting of integration.
So moving databases, merging billing codes, making sure the U.S. Cellular customers didn't lose service when they switched over, all that stuff.
Exactly that. It is grueling, high-intensity, expensive work. It's project-based revenue. But here's the thing about integration. Eventually, it finishes. The systems are merged, the project ends.
So that revenue stream just turns off.
It evaporates, it's non-recurring. So what's happening is that the integration revenue is falling off a cliff because the job is done. The managed services revenue, which is this steady, boring, keep the lights on work, is continuing under the new contract. But the steady work just isn't big enough to fill the hole left by the integration work ending.
Wow. That is a fascinating dynamic. It really highlights the lumpiness of being a consultant, basically.
Yeah.
You eat what you kill,
Yeah.
and when the big beast is fully eaten, you have to go find another one.
And that's the problem. Their backlog is huge. $4.25 billion, a record high.
Right.
But backlog is just a promise of future work. It doesn't tell you when that work turns into cash. And telcos right now are being incredibly stingy. They aren't starting new massive integration projects. They're cutting CapEx.
Because they spent billions on 5G spectrum and towers, and now they're hung over from that spending spree.
And they are looking at Amdocs and saying, we love you, but can you do this cheaper? Which leads us to the solution Amdocs is pitching to solve all of this. Artificial intelligence.
Of course, if your stock is down, just say AI 5 times fast.
So they're rolling out something called AOS, the Agentic Operating System. They're showing it off at the Mobile World Congress in Barcelona next month.
Is their attempt to change the narrative from boring utility to tech growth story?
Agentic is the key word here, right?
Yeah.
We need to distinguish this from just a chatbot. We aren't talking about a customer service bot that tells you your balance, are we? No, and that distinction is vital. A chatbot generates text. An agent takes action. The promise of AOS is that it hooks into the deep back-end systems, the OSS and BSS.
The operations support systems and business support systems, the plumbing.
Exactly, the plumbing. So an agent doesn't just say, I can help you with that. It actually goes into the database, executes the code to change your plan, provisions the new line on the network, updates the billing cycle, and sends the confirmation.
So it does the work of a human operator, but autonomously.
Right.
That sounds incredible. It also sounds terrifying if it hallucinates.
Which is why adoption is slow. But Amdocs is also playing the sovereign AI card. They mentioned a partnership with TELUS in Canada involving a sovereign AI factory and NVIDIA.
Sovereign AI meaning data that stays in the country.
Yeah, data residency is a massive issue for telcos. You cannot send Canadian customer data to a server in Arizona to be processed by OpenAI. It breaks all the privacy laws. Amdocs is building infrastructure that allows these AI models to run locally within the telco's own secure perimeter.
Okay, so the tech sounds legitimate. It solves a real problem. Why didn't investors care? Why didn't this boost the stock at all?
Because management was, maybe too honest. When the analysts pressed them on the call, how much money will this make in 2026? Management basically said it's in the numbers.
Which is code for it's not moving the needle yet.
Exactly. It implies that any revenue from AI is just replacing revenue lost elsewhere. It's baked into that 1.5% growth guidance. Investors wanted a hockey stick. They wanted to hear AI is going to double our growth rate.
And instead they heard AI helps us stay relevant.
It's a defensive move, not an offensive one. They have to do it just to keep their customers, but they aren't charging a premium for it yet.
And that is the utility trap. You have to upgrade the grid just to keep the lights on, but you can't double the price of electricity.
Right. Amdocs is spending heavily on R&D. They're partnering with NVIDIA. They're building these sovereign AI factories. But the financial payoff is invisible right now.
Speaking of spending money, we have to touch on the acquisition. They spent nearly $200 million in cash to buy a company called Matrixx Software.
This flew under the radar because of the CEO news, but strategically it's actually Huge.
So why burn $200 million in cash when your stock is tanking? What does Matrixx give them that they didn't have?
It gives them the little guys. Amdocs already owns the high end of the market, the tier one giants like AT&T, thanks to their previous acquisition of OpenIt. Matrixx specializes in a different kind of billing engine. It's cloud native, it's lightweight, and it's perfect for MVNOs.
The mobile virtual network operators. So the Mint Mobiles, the Crickets, the Visible Wirelesses of the world.
That whole segment is growing way faster than the legacy carriers. By buying Matrixx, Amdocs is essentially buying a monopoly on the cash register of the telecom world.
Ah, I see.
So whether you are a global giant or a scrappy startup carrier, if you want to bill a customer for data, you're likely going through Amdocs code now.
It's a moat play. They're just digging a trench around the castle.
Yes. But again, look at the guidance. They spent $197 million, which is about half their M&A budget for the year, and they still didn't raise the full-year revenue outlook.
So they bought revenue just to stand still.
That is how the market interprets it, running hard to stay in place.
Let's zoom out to the macro picture. We have a stock trading at 52-week lows. It pays a dividend, about 2.7%. Management is buying back shares. They promise high single-digit returns. I mean, in a normal year, that's a safe, boring, responsible stock.
But this isn't a normal year. We are in a market that is obsessed with AI hypergrowth. If you're an asset manager, why would you park money in Amdocs for a potential 8% return when you could put it in a semiconductor stock or a hyperscaler that might do 30%?
The opportunity cost is just too high.
Plus, the sector headwinds are real, the telcos are under pressure, they're cutting costs. And we have to be honest, Amdocs is a cost. When Verizon or T-Mobile wants to save money, they squeeze their vendors.
Yeah.
Amdocs is pitching automation to help them save money. But that ultimately might mean fewer billable hours for Amdocs' human consultants. It's a cannibalization risk.
So we're in a show-me state of mind. The market is just folding its arms and saying, prove it.
They're suffering from what's called multiple compression. Investors are just not willing to pay a premium for uncertainty. They need to see Shimi, the new CEO, actually execute. They need to see the AOS actually getting bought by customers, not just demoed on a stage.
Which brings us to the most interesting part of this deep dive. We have a catalyst coming up. Mobile World Congress is in March. The new CEO takes over March 31st. The stock is beaten down. This feels like a setup for something volatile.
It's a powder keg. The stock is priced for boredom, but the calendar is full of drama.
Okay, disclaimer time.
Yeah.
We are just two voices on a show. This is not financial advice. We are not your advisors. Do your own homework. Do not trade based on what we say.
Yeah.
But if we were looking at this purely as a game theory scenario.
If you're looking for an asymmetric bet, this is it. I call this trade the Barcelona bounce or bust straddle.
I love a good title. Walk us through the logic.
Okay, here's the setup. The market hates the uncertainty. It hates the CEO change. It hates the boring guidance. So the stock is just sitting there at $81. Implied volatility, the price of options, is relatively low because everyone thinks Amdocs is a sleepy utility stock.
So you're saying insurance is cheap?
Exactly. A straddle means you buy a call option, betting it goes up, and a put option, betting it goes down, with the same expiration date. You target an expiration just after the Mobile World Congress in March.
So you don't care which way it moves, you just need it to move a lot.
You need violence in the price action. And we have two very plausible scenarios for violence.
Okay, scenario A, the bull case.
Scenario A, the new CEO, Shimi, steps onto the stage in Barcelona. He demos the AOS. It's flawless. It shows real-time ROI. He announces a pilot program with a major European carrier. And suddenly, the narrative flips from boring utility to AI sleeper pick. The stock is at a 52-week low. It snacks back 10 to 15% just to get back to fair value.
A relief rally, the we aren't dead bounce.
And then there's scenario B, the bear case. The demo is viewed as vaporware. The T-Mobile revenue decline narrative starts to really panic investors. They realize the backlog isn't converting to cash fast enough. They start worrying that the dividend isn't safe. The stock dumps another 10% into the 70s, breaking all technical support.
So the thesis is essentially, the market thinks this is a boring stock, but the next 30 days are going to be anything but boring.
Correct. The current valuation assumes nothing happens. I am betting that something happens. It's either a value trap about to collapse or a turnaround play about to launch. And March is the deciding month. Sitting at $81 makes no sense given the news pipeline.
It's the Barcelona bounce or bust. I like it because it removes the emotion of trying to pick the winner. You're just betting on chaos.
Chaos is the only thing we can guarantee in this sector right now.
So let's wrap this up. Amdocs delivered a solid quarter that the market hated. They're changing the pilot in the middle of an AI turbulence zone. They have a product that sounds revolutionary but isn't paying the bills yet, and they're asking investors to just trust the process.
It brings up a bigger question for the whole industry, really. Amdocs is the plumbing of the internet. If the company that literally controls the data flow and the billing for billions of people can't figure out how to monetize AI immediately,
then maybe the AI revolution is a little harder than the PowerPoint slides suggest.
Maybe the plumbing is just too rusty to handle the new pressure. We'll find out in March.
Keep your eyes on the Mobile World Congress headlines. And as always, keep your eyes on the ticker. This has been Talk Tickers. See you next quarter.